All right, today we're going to do something a little different. We're going to play detective. We're digging into an economic cold case, a crime scene from about 50 years ago that has stumped experts for decades, and it holds a really crucial lesson for our economy today.
So you've probably heard those stories, right? About a time when a dollar just didn't stretch as far, when your paycheck seemed to shrink every single month, and the future felt, well, pretty scary. This wasn't just a vibe, it was the reality for millions of people, and it's the backdrop for a huge economic mystery.
We're talking, of course, about the 1970s. It's a period economists now call the Great Inflation. It was a decade where the economy just seemed to go completely off the rails. And the big question has always been, why? What on earth happened?
Okay, so here are the clues from our crime scene. You've got high inflation and high unemployment happening at the same time. Now, that's not supposed to happen. It was so weird, economists had to invent a new word for it, stagflation. But in the 70s, it was real. Prices were soaring, people were losing their jobs, the economy had just flatlined, and nobody knew when it was going to end. It was, simply put, a perfect storm of economic misery. And this is the question at the heart of the whole mystery, the one that economists have been fighting over ever since. Was the U.S. economy just the victim of some seriously bad luck, one unfortunate event after another? Or was somebody at the controls making some catastrophic mistakes? So, to solve this thing, we need to line up our primary suspects. And in this particular case, there are two major theories that have been battling it out for years. Let's break them down. Okay, suspect number one is bad policy. This theory points the finger directly at the Federal Reserve, America's central bank. The accusation? They kept interest rates too low for too long, basically flooring the accelerator when they should have been slamming on the brakes. Then you have suspect number two, bad luck. This theory says, hey, hold on a second. The Fed was a perfectly good driver, but the road suddenly became a minefield of oil crises and other global shocks that were just impossible to dodge.
Now, to really get the bad policy argument, you have to understand this key term, passive policy. It sounds kind of harmless, right? But in economics, it is incredibly dangerous. Here's what it means. Let's say inflation goes up by 1%. A passive policy is when the central bank raises interest rates, but by less than 1%. And the result of that? The real cost of borrowing money actually goes down, which just encourages more spending and borrowing. It's like throwing gasoline on an already out-of-control fire.
For years, this case was just completely cold. Economists argued back and forth, but the evidence was always just a little too blurry to really pin the blame on either suspect. That is, until the paper we're looking at today came along and introduced a brand new forensic tool, one that could finally bring the whole picture into sharp focus.
You know, imagine trying to identify a criminal from a super grainy, out-of-focus security camera. That's kind of what the old economic models were like. They were okay at spotting the big, sudden shocks, but the slow, gradual shifts in policy, the stuff that might have been the real problem, were totally invisible. This paper's method is like upgrading that camera to 4K high definition. Suddenly, you can track all those subtle, drifting changes over time, giving us a much clearer view of what was really going on.
All right, so with our new high-tech tool in hand, it is time to reopen the case file. Let's dive into the data and see what it tells us about our two suspects, bad luck and bad policy.
First, let's look at the evidence for bad luck. What you're seeing here is basically an economic earthquake meter. It's measuring the size of all these unexpected shocks hitting the system, things like sudden oil price hikes. And you can see it, plain as day. Those lines get incredibly spiky and volatile right in the middle of the 70s. So this confirms it. The bad luck theory definitely has a point. The road really was getting a lot bumpier. So case closed? It was all just bad luck? Well, not so fast. Because think about it, a bumpy road doesn't automatically cause a crash if you have a good driver at the wheel. And this is where the new evidence from our economic detectives reveals a critical plot twist.
And this chart right here is the crucial clue. This line tracks how aggressively the Federal Reserve was responding to inflation. If the line is above 1, they're actively fighting it. They're hitting the brakes. If it drops below 1, their policy becomes passive. And just look what happens. Starting in the late 60s and going all the way through the 70s, that line just plunges and stays in that passive zone. This is the evidence. Right when the road got bumpy, the driver took their foot off the brake.
So now we've established that both suspects were at the scene of the crime. We've got the bad luck of all those external shocks, and we've got the bad policy of a passive Federal Reserve. But that just tells us who was there. The final question is, how did they work together to create such a disaster? What was the mechanism? Now we're looking for the smoking gun.
And here it is. This is the smoking gun. The line with the circles, that's inflation. We already knew it was rising. But the critical piece of evidence is the line with the crosses. This measures inflation persistence, basically how stubborn or sticky prices are. When persistence is low, a price shock goes away pretty quickly. But when it's high, inflation gets lodged deep inside the economy. And you can see it. The moment policy went passive in the 70s, that stickiness went through the roof. Bad policy didn't just let inflation rise, it fundamentally changed its DNA, turning it into this stubborn monster that was incredibly hard to beat. This was the deadly combination.
So the final verdict is in. It wasn't just bad luck, and it wasn't just bad policy. It was the interaction between the two. The external shocks, they started the fire. But the Fed's passive policy, that poured gasoline all over it, turning a bad situation into an absolute inferno that was nearly impossible to put out.
So you might be thinking, okay, that's an interesting history lesson, but why does a 50-year-old economic mystery matter to me today? Well, understanding this story is absolutely critical if we want to prevent it from ever happening again.
This timeline shows us how the story ends. After the disaster of the 70s, a new Fed chair, Paul Volcker, comes on the scene. He does the exact opposite of his predecessors. He switches to a fiercely activist policy, jacking up interest rates to crush that sticky inflation. It was painful, no doubt. It caused a pretty bad recession in the short term. But it worked. By the mid-80s, the inflation monster was tamed, and the economy entered a long period of stability we now call the Great Moderation.
The takeaway here is so powerful. The decisions made by a small group of people at the central bank, based on how they understand the economy, have profound, direct consequences on the price you pay for groceries, on your ability to find a job, on the value of every dollar you save. This is not just some academic debate.
And that brings us right to today. The story of the Great Inflation is a permanent warning. It shows how a flawed understanding of the economy, when it gets combined with just a little bit of bad luck, can lead to a total disaster. The question it leaves us with is a crucial one. Have we truly learned the lesson? Or is history just waiting for its chance to repeat itself?